when you look at long-term trend factors, technical stuff we look at, momentum, it was merely a storm without breaking anything. And there's no structure it broke, no trend. It didn't even jeopardize. Frankly, there are no real developed momentum, what we call momentum trend structures, that are anywhere nearby. And normally, and I'd say normally almost 90% of the time, whenever a market makes a top of significance and lasting, or a bottom, you'll be able to look at a momentum chart, like a long-term momentum chart, where you measure price, let's say, oscillated in relation to a 3-year average, or oscillated in relation to a 3-quarter average, or something fairly long-term. You'll see structure on the momentum chart that says, oh gosh, there's a line, I better not break. And almost always, when a top is made or a bottom is made, you'll find that the breakage occurs not very far in time or price from the high or the low. This occurred, for example, 2011. We peaked in September, I think it was. We turned major bearish in December and then in January 2012. Okay, a couple of months off the high, a couple $100. And in fact, it labored for another year before it really fell apart. That's gold I'm talking about. Mm-hmm. And but the structure was, if you looked at the momentum chart, you'd say, good grief, any idiot could draw that line. But it wasn't evident on a price chart, but it was a momentum. Same with the bottom. 2015, after the 50% bear market, gold bottomed. And when you looked at the annual momentum chart, not the gold price chart, it kept just staircasing down a little bit, you know. It slowed up, but you looked at the momentum chart, there was a chart pattern there that you said, good grief, look at that ceiling. It's 3 years wide. You keep going the same level. When you broke through, it was February 2016, mere $90 off the price low and 2 months after the price low. Whereas when we look at the charts now, gold or silver, and run any long-term study, there's no nearby momentum trend structure to even break. Mm-hmm. And so we think it is merely a violent jiggle in the middle, and I suspect it won't take a long time to recoup from it, meaning you might be in new highs next month or so. The issue is to see if it continues right now or not. And, you know, you start with today. Let's just check it out, see what's happening. You know, get through the next day, then the next day. If all of a sudden you start oozing back up into that range, then you can wipe your brow, and it was a one-day phenomenon, really. Anyway, that's what we see there. And no, we did not call that break, and there's a reason. But we run very short-term momentum charts, like day-to-day action, which is what everybody seems to be preoccupied with. We saw a trend structure that broke Friday, early morning, and said, oh, I'm going to go down. But you'd had those same type of breakage points when you run the short-term momentum that occurred every couple of months. And usually the consequence is, oh, you get a bad day, you dust yourself off, and then you're back up again. This one was different. Not because of anything big it broke, but it broke daily structures, which meant, you know, short-term. But it was deep. So, no, we did not anticipate the depth whatsoever. And we don't want to cry out to our subscribers all the time every time we see a little twitch that says, oh, we're going to drop for a day or two, because then you scare everybody out of the market. But anyway, right now our assessment is wipe your brow. It's probably a one-day phenomenon. It didn't break anything. It's just noise in a very thin atmosphere. And I don't think it's an indication of sustained downside.
The move downward, I think it was, for silver, it was a historical move, like it was the most it's ever moved in a day. I think since the 80s or something of that nature. I'm curious if, so there's a lot of different theories as to why this happened. Some people are saying like, oh, it's the banks. Some people are saying like it's the fund managers who have to rebalance their portfolios by February. Some people say it's the Iran thing. You know, there's so many different narratives out there, right? And so like
every day there's all that stuff out there.
Yeah. And so I'm just kind of curious, many people have been calling for triple digit silver. for a while, and we've hit that, and so that's a huge milestone. Some folks are kind of wondering, like, okay, is this the top? Was this the top? Did I miss my opportunity to sell? Obviously, silver came down to 75. I mean, it was at close to 120. And so I think that's probably the question that's on a lot of people's mind was, did I miss my opportunity to sell? Was this a 2011 where it hit 48 and then didn't rebound for a number of years? And so just curious in your perspective there.
Yeah, well, it was confined for half a century in a range from $4 to 50, okay, back and forth. That's where you're going to stay, man. Meanwhile, gold had blown out the 1980 high in 2011. Silver didn't. And then it blew out the 2011 high, coming up through 1920 a couple years ago. And boom, boom, massive gains. You could even look at a chart of copper. Don't laugh. It stayed in a range from the 70s, 80s, 90s to about late 2005. Copper was selling for 50 cents a pound to $1.50, 50 cents a pound to $1.50, like silver was for 50 years in a $4 to 50 range. Okay, copper was in a similar old reality. This is 2005 now. We're going back. Late 2005, copper finally broke up out of that range. Took it a couple months of struggle, but definitively you could say, okay, finally it's up out of that range. Within a couple quarters, it quadrupled in price up to $4 plus, from 50 cents to $1.50. And then, there were sell-offs after that, but it didn't come back to 50 cents or $1. It had a range of, average price probably $3.50 or $4. Like 4 times the height of the prior 50 year. Lead did the same thing in 2007. How come silver is supposed to stay in its half-century range when nothing else has? Okay, so it finally broke out. And if we look at the copper and the lead charts back in 2005 or lead 2007, when it broke out, within several quarters, you quadrupled the price. And it wasn't like a broad base metal explosion. It was copper, and then a year and a half later, it was lead. And then when you look at gold, repeated massive new highs. And silver is contained. Well, there's some explanations as to why that mistake has occurred. But when markets make pricing mistakes, they get into a range, let's say excessively too high for too long, like a stock market bubble, for example. When they go down, they often go way more than to correct for that. If they should drop 50, they go 80% down, like NASDAQ did in 2002. Why should silver stay confined in the $50 range? Well, it broke out. And here's 2 simple methods of determining, well, where might you go? If you look at an arithmetic chart, which is what people punch up on their screen, dollar on the side, dollars on the side, but not logarithmic or ratio scale. You see this $4 to 50, $4 to 50. You broke out, but when you measure the thickness of that perfect rectangle and do the orthodox technical analysis thing, you got a range, call it $45, $5 to 50. We call it 0 to 50 if you want. Add 45 or $50 to $50, and that's your swing objective, the thickness of the prior range. Well, you'll remember back a few weeks ago, we had a struggle going on for a week or so in the low to mid 90s. In other words, there were a lot of sellers there saying, hey, we've met the arithmetic swing objective. I'm getting out. Okay. And then all of a sudden, boom, got 121. So it's evident now, okay, getting to 121 means the old arithmetic ratio or arithmetic swing objective was invalid, okay? But when you put silver on a logarithmic scale chart, a ratio, and you measure the dimension of that 50 half-century range, from the bottom of that range to the top of that range was a 10-fold gain. If you bought silver for $4 or $5 and it went to 50, $4 or $5 went to 50, wow. 10-fold gain, back and forth. Okay, now, look at the mama market, gold. During that same time, it had 8-fold gains, but they exceeded prior gains. They didn't stay capped. So if you look at each of the bull markets, like the peak in 1980, the peak in 2011, they were 8-fold multiples. And right now, gold, by the way, gold's recent high is only a 5-fold multiple from the barrel. So it hasn't even matched those yet. But in the case of silver, if we do the ratio scale and do the same, well, what's the thickness of the range? Add it to it. It says $500. Don't laugh. Heck, if you know, maybe it's been restrained too long. Maybe it's way too cheap in relation to gold. That's a measurable fact. Maybe it's way too cheap in relation to its own reality. It's way too cheap in relation to the degradation of the money unit. Look at an M2 chart. Look at this growth decade by decade. If silver matched the 1980 high, I haven't done the math. I bet it's like $400 or $500 just to match.
Yeah.
1980. So
No.
talk about, oh, was that the top? Even using simplistic methods, no. By going way beyond the arithmetic gold, it's saying, hey, maybe I'm going to the ratio scale gold. Well up in the 300, 400, 500 range. That's what we think is about to happen, and we think this is simply a midpoint gut kick, not a top. The other issue is, what's your point of entry? If you're not a trader now, okay, forget the trader. You know, he's in and out every week, so his reality is week to week, okay. But a guy who's an investor, our last two major buy signals for silver. You know, originally, back February 2016, we said gold's turning up and silver, you know, that was the bottom for silver. Okay, fine. But since then, we gave a couple other entry points that we considered good investment grade entry points based on momentum breakouts of silver and based on its spread relationship to gold. In other words, when you plot silver month to month versus the price of gold, and you plot that chart, and what we do is we divide silver into gold, express it as a percent. So early last year, for example, silver was 1% of gold. Now it's up toward 2. Okay, nice move. But historically, if you go back a long way and plot that chart month by month, you'll see that for 10 years, there was a ceiling on that relationship at a very low level. And we cleared that in November. And when we cleared that and silver broke out versus gold, in other words, no longer the dog, I'm going to lead now. Okay, that's what silver said. That was $50.
Yeah.
And boom, okay, what happened since? Okay, so if your entry level was back in June of last year where we had our first buy at $34.79, or at that $50 level, yeah, you gave back some profits, but you didn't get anywhere close to your average entry price. So again, point of entry is very important. And it probably affects the way a lot of people are thinking about this right now.
Yeah, I mean, even the correction we had back in, what was it, October? I think, you know, I had jumped back in and started buying silver at 45, you know?
Yeah, Well, you were dumb, see? No, you weren't. That's right, it worked. You bought weakness. Admittedly, this is sharper than even we expected, but we did expect somewhere in the middle of this clock, and we set our clock as of the November close, meaning when that spread relationship of silver versus gold breaks out, of such a clear structure, you'll get a gusher. And whenever that's happened before, usually it lasts a couple quarters, where silver has had its breakout, it says, whoosh, I'm going to regain some reality versus gold. We're only starting month 3 of what's likely to be a couple quarter explosion. And again, harken back to the copper move and the lead move I mentioned, when they broke through their old reality, a couple quarters later, quadrupled, you know. So that's where I think we are. It's just, yes, it's scary. All we're looking for now is stabilization and some sign that we're coming up out of here, not going back to the highs. That'll be a late issue. But somewhere in between here and there, we're going to come up with some numbers that says, oh, yeah, that was it. If you're not in, this is a good time to buy.
Looking at the miners, right? So the miners sold off significantly. Many of them just got pummeled. And I'm thinking, okay, well, you know, they're producing, they're getting the metal out of the ground, they're selling them at these current high prices, and they're factoring in like all-in sustaining costs. It varies for the different metals. But I'm thinking like, okay, people are selling these miners are going to be, you know, raking in the cash, you know, and so, you know, I was kind of wondering about that. What do you think about the miners?
I think this is well, we favor the miners over gold, and there's a level though that we haven't broken through yet. What we do is we measure the XAU index, which is the Philadelphia Gold and Silver Index, but it's miners, okay? It goes back to the 1980s, so you got some history on it. We plot it in its relationship to an ounce of gold. And if you do, and you go back to look at 1980s, 1990s, 2000, until 2008, for several decades, if you divided XAU into an ounce of gold, you'd end up on average, above and below, a range of 25%. It reached up to 35% at one time, and its lows during this multi-decade period, when you plot the charts like a box, okay, we're in the 17, 18% level. You broke through that in late 2008, and you collapse that spread, meaning the value of the miners to what they get out of the ground, okay, to 4%. Now think about that. Something that had lived in an average price versus the thing it gets out of the ground, gold or silver. It went to 4%. I mean, we don't need miners. We need gold, silver. We don't need the miners, right? Okay. That chart is screaming at you, hey, you think I'm going to go to zero? And so since 2014, you can plot a range on that same relative performance chart. Beautiful little box. And it's like from 5% up to 8 plus, 5% up to 8 plus, 5% up to 8 plus again, intra-month, last month. Right now it's back below 8%. But if you get much above the top of that range, and we think this third assault on the upper end is probably the one that's going to break out. So it didn't break out last month. But you get up above the top of that little box. Again, visualize that as a chart. When you break out above that beautiful technical range, there's nothing to stop you, technically speaking, in terms of the value of the miners to the metal they get out of the ground, until you get up to 17 or 18%, which is to say, to go bump the bottom of the floor that had existed for decades. So you go from, boom, you could double the miner's value relative to gold. And I strongly suspect that's about to occur and will show itself this year. Probably the breakout I'm expecting next month or so of that spread. And when those spreads break out, like the silver did back in the November close, look what happened to net price over the next 2 months. It went berserk. Expect the same from the miners. So you're right, And there's 4 miners coming up with silver miners coming up in the first 2 weeks of February with earnings for the biggies. That report will be based on what? Fourth quarter, right? Okay. Go back and look at a silver chart. Where was it during the last quarter of the year? So, that's what they get out of the ground, therefore their profits are, et cetera. Average $50, okay? Somewhere either side of 50. Right now, so far in the first month, our average price is, well over 100 average price now I'm talking. And if we stabilize here and then sort of work our way back up so that February and March we're back up toward 100, 120 again, then your average price for the new quarter is going to be about 100. Okay, double what it was before. So the guys who look at earnings and say, wow, this miner's making a lot of money at $50 last year. Golly, gee, that's really good profit. Because remember before when we were at 50 in 2011 and 1980, you collapsed from it quickly. You didn't stay there. So you never got an average price up there. This time they had an average price in the fourth quarter of $50 or so. Wow, so the earnings have to look real good. Imagine what they look like if this quarter has an average price either side of 100.
Yeah.
So if you're looking at that as a factor, whether you should tell your clients to buy silver miners or gold miners, you don't have any excuse now not to say yes, based even on the fourth quarter earnings, much less what looks like could be evolving for the first quarter. You get the point. There's a fundamental reason, too. They're underpriced in relation to that which they get out of the ground. I think the reality will hit people. And a lot of people don't like to invest in, let's say, silver futures or call options on SLV or, they just want to buy miners. It's a stock in their stock portfolio, and they're haunted by certain memories that are false and also brief, like that 2008 collapse in the miners, which happened to concur with the S&P that month. But at that point in time, the miners relative to gold were actually breaking down on that spread relationship I talked about, where for 3-4 decades they'd been average 25%. Well, in September of 2008, they broke below the bottom of that whole multi-year performance range versus gold. This time it's just the opposite. They're cheap in relation to gold. They're cheap in relation to the stock market. They're cheap in relation to everything. And people have just been dismissing them. And yet when you look at the earnings based on, what's the average price of silver last quarter? What's the average price of silver now this quarter, or gold? How can you dismiss them? Well, finally, portfolio managers and the financial planners and so forth will have to say, yes, Mr. Jones, you're right for asking me about the miners. I kind of agree now. You can put that in your portfolio. Why? Because the earnings look great. So there may be a whole new wave of public buying. That's what I'm saying. Like especially when these next earnings reports come out for the miners in February, that start to turn heads. And if anybody does a relative study of miner value to the metals, geez, it's ridiculous. You want to buy cheap? Buy cheap.